Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Katy Kaminski and I, Niels Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Katy, it is absolutely wonderful to be back with you this week. How are you doing? What's going on in Boston?
Good. I mean, we're ticking along here. I mean, trends are working well again, so that's exciting. And I can't believe we're already so far into the year. I mean, this is amazing. So time flies.
I know. Have you had any snow yet? I was close to Boston a couple of weeks ago, and I see now that in Montreal, for example, there is snow now. But what about you?
We missed some of that, but we did have sort of a super cold chill, and ironically, over Veterans Day, and the heat was off in our office, and I was wearing my parka. So I was like, oh my gosh, we're here. It's winter. Yeah. So definitely getting ready for the cold here.
Yeah, no, absolutely. We've got a great lineup, as I always say. So some, important talking points, no doubt. But before we do that, I always ask you about what's been on your radar. And I know you said, well, I don't really have anything specific, but let me mention a few things. And what has been on another person's radar that involves you is that my daughter actually met you in Boston, and she thought you are the coolest and most chill person and very inspiring. So I just wanted to publicly acknowledge you for taking time out to see her.
No, that was awesome. So fun to get to meet your daughter. I've heard so much about her over the years, and she was visiting Boston, which is such a fun place to be when you're, exchange student or whatever.
Yeah.
So, I mean, I was very impressed with her organization and structure on her trip. So she must have inherited that from you, Niels.
Not sure about that, but she is very organized. Okay, all right. So what's been on my radar? Flying around, and in the US last week, of course, the government shutdown was a little bit on my radar because everything was a bit delayed. But one thing I thought of is, despite whatever it was, 40 days of no government data, the markets didn't really seem to be too bothered about that. So the question is, do we really need economic data all the time to be good investors? Katy, what do you think?
Oh, that's a really good question. I mean, I think it's been kind of a nuisance in some sense because, we're so used to the routine. Here's non-farm payrolls. Here's this. And, I think people are a little out of sorts. I feel particularly bad for the people in the media who are just used to that routine that, Friday's release. And I think that must have been hard for them, kind of thinking like, how do we structure if we don't have any data?
As I hear you talk about it, it actually reminds me of something we're going to be talking about later, because we're going to be talking about diversifying trends. And one of those are this economic trend that AQR is doing. And I'm kind of thinking, wow, economic trend, no data. That's not a great situation to be in. Not that the economic data changes that quickly, but still, it kind of shows you a little bit of a weakness, similar to if we didn't get any data from the exchanges for 40 days, that would be a little bit of a challenge.
That's a good point. I mean, and let's start asking the question, like, what if the data gets, manipulated
Distorted.
too, right?
Yeah.
I mean, that's another thing we can think about is, we know the head of data for was also fired, right? So, I mean, you got to start asking that question as well. But I guess the point is, there's official data and then there's also lots of other sources of data. So I think that it'll be interesting to discuss.
I think in our industry, Katy, we've always talked about that the only truth is the market price, because that's where the market is clearing. And maybe that's a good reminder that price data is really pure and important in many ways. I'm sure there's maybe small commodity markets that can be manipulated, but anyways. So that was one thing that was on my radar. The other thing that was on my radar is closer to you than it is to me, because it's about what's going on the west coast of the US. Because next week, one of the largest pension funds in the world, I think CalPERS, they're going to vote on adopting the total portfolio approach. And I'm not an expert in that, but my understanding is that if you adopt the total portfolio approach, each individual investment kind of, you look at the value it adds to the portfolio as a whole. That's kind of the justification. And I'm thinking that alternative investments, and specifically something like trend following, which we know objectively, empirically, we know that that is, non-correlated, et cetera, you would think that that would move up the list, so to speak, of really valuable components in a portfolio like that. So, and I know this is completely off the cuff, of course, but do you think that that's these pension funds that are now adopting this, that it will have an effect on, say, alternative investments, percentage allocation in a portfolio, maybe even managed futures allocation in a portfolio?
I definitely think so, because we've often talked about this concept of locally optimal versus globally optimal, and why, a trend strategy in general is one of the few strategies that is so complementary, in the sense that you end up with total portfolio risk reduction. And I think that is not always the case for a lot of other alternative strategies. And I think, we've seen this in the success of risk mitigation strategies and buckets, where they've actually tried to create a bucket where you get that total portfolio effect. But by creating the bucket, they created a list where they could put that. Because I think the line item problem and sort of the subdivision of labor in the investment management creates this very siloed view from time to time, where you're optimizing each of your buckets or each of the line items, but maybe not able to see sort of the total portfolio view as easily. So I do think, philosophically, that's very aligned with how we think about things in our space.
Yeah, and it reminds me of a conversation we had with Elizabeth Burton, who at the time were the head of pension fund in Hawaii. Now she's with Goldman Sachs. And she told us that they had completely stopped using anything to do with buckets. They just looked at things individually and so on and so forth. So very interesting indeed. Now, the final thing that was on my radar has nothing to do with trend following or portfolio management. It was just a little blog post that came out from a previous guest of ours, Ed Yardini, and talking about the enormous demand for data centers, right, with all this AI going on. And, I was stunned by the increase in, he talks about the spending for building the data centers, and also the Microsoft's CEO came out saying that's actually where the shortage is, not in getting the chips, but actually getting the centers to put the chips in. And it had gone up, the spending, like 400% in 2 years, which is crazy. And then the power. Where US has by far the most data centers, more than 4,100, and it uses about 183 terawatt hours of electricity last year. But they're expecting that to more than double in the next 4 or 5 years. And I think now 26% of total electricity supply in Virginia is consumed by data centers. These are staggering amounts. And if we don't know where inflation might come from, I would say electricity prices is a good guess.
Oh, yeah, definitely. And there's a lot of other places as well. I was looking at numbers for U.S. healthcare as well. There was some interesting stats on that. So there's all these little different places where you're seeing that things have gone up substantially, insurance costs, et cetera. So, I think it's coming. Price increases may not come linearly, and we know this with inflation, but they do drift. So I think inflation is still a very interesting topic to think about, especially over the next few years. And I think Wasn't the podcast last week you guys were talking about inflation as well, and one of those great papers that I think Yov was talking about that too. That
Yeah, I think Joab and Alan was
yeah,
talking about it when I was traveling. Yeah,
yeah, and
absolutely. Yeah.
there. What I think is interesting about it is we did a very long study of inflation for trend following, and trend
Hmm.
following does really well in high inflation and rising inflation. So,
Yeah.
we might be the only people that might be slightly happy about that. So, because in
But
general, it's
but
difficult.
But talking about that, because I do think that's relevant, my non detailed analytical view of that is that actually we don't care so much about the level of inflation, but we care that it's not stable.
Hmm.
Because when I look at the performance periods over time, the worst period for CTAs has been this 2000 to 2019, where we had low but also stable
Hmm.
inflation. When we had from 1992 until or maybe it was 82 to 2000. I can't remember. It's like a long period, 17 years. So it must have been 82 to 2000, where we had relatively low inflation, but it was not stable.
Hmm.
And that actually, when I look at Don's track record, that was the highest compounding period. So not the highest inflation level. That was back in the 70s and early 80s, but it was just an unstable inflation. And I feel that's kind of the environment that I'm expecting. Not so much, that we have 88%, 10% inflation constantly, but actually just that we can't control it or central banks can't control it.
That actually makes sense. I mean, because it's more the disruptive nature and sort of the trends that creates. So, for example,
Mm,
electricity prices might be sort of a pocket where you see the inflation surging, and then you may see inflation dropping in other areas. And I think
right.
it's that sort of turbulence in the inflations or changes that probably causes more sort of is indicative of price trends because obviously inflation has to do with how much prices move, right, as well. So
Yeah.
there's some relationship there as well.
Yeah. And even in a relatively stable inflation environment we've had the last 18 months, I mean, bonds, where you would think, oh, there must be a link to that, that has not been an easy place to operate in, as we will talk about, I'm sure. Anyways, let's talk a little bit about trend following. October had a couple of days in October. The first couple of days of October was actually a little bit soft, and you think, okay, natural correction. But that's really changed. We're seeing a lot more managers now to be well aligned with these longer term trends that have come back in play. Obviously, equities seem to be never stopping. And I was looking at something I picked up, and I think this is from Deutsche Bank. Actually, they had a chart that shows the total equity fund flow in percentage of assets. And it compares this year, week by week, with the average or the mean or median from 2010 to 2024. And it's very interesting to see how much more inflows you've seen this year than the average from 2010 to 2024. So no doubt that there's a lot of flow behind the constant increase in equities, which of course works very well with trend following as long as there's no politicians that are trying to upset that trend. Precious metals continues to do really well. Softs doing okay, but slightly different direction depending on which commodity you're looking at. And even currencies, although not overall for the year, has probably not been great, but the last month or so starting to pick up, which leaves us, as I mentioned before, with fixed income being the big challenge.
Yeah, that's it. I mean, you summarized it perfectly. I think we've seen, a consistent equity trend move that has been sort of surprising if you think how we felt earlier this year.
Mm,
We had been talking about this idea of, is the risk really overstimulation at some point, maybe inflation at some point. Obviously, we've been a little bit at limbo in those narratives without official data coming out. But I think the trends that I'm seeing that have been hard are things like energies that have been back and forth.
mm,
And also fixed income has been a year where you're sort of the market wants cuts, especially for the US, but they're waiting for them. So those trends, I've seen less risk in that asset class. So that could be something interesting next year, perhaps. Currencies, you have seen a little pivot in the sort of weak dollar theme, which is
mm.
kind of interesting to me as well. Is the dollar kind of moving on potential slowdown in rate cuts that people don't expect? Or is it, kind of has it bottomed out because it moved so far this year? So I think that's an interesting asset class that's a little different right now. And of course, the best trades for trend this year, precious metals, right? So gold, silver, platinum, palladium, any of those markets really sort of surging on, what I think it looks a little bit like a hedge, right? So, you want the equities, but if you're worried, you buy the safe asset. The dollar doesn't look good, so you go for gold and you hold the gold. It could also be, central banks and just people general demand for gold. So it's definitely an interesting year for precious metals.
Yeah, no, it is. And I was just looking at it this morning, and even just we're not that far into the month of November, but silver is up, 12%. Silver is up 73% this year. Platinum, 68%, and gold, 59%. So hopefully that's a good indication for people to realize how important it is to trade commodities and not just be stuck with the usual suspects in a traditional portfolio. Well, at the same time, orange juice is down 65%. So there's a little bit on both sides for those who do trade orange juice. But there we are. Now, this environment is also being reflected in my own trend barometer. We're up at 57. That's kind of, I don't remember everything that's been going on this year, but it is certainly one of the highest levels I've seen. So very much in line with recent performance. Beta 50 index as of Tuesday, the 11th, close of business, is up 93 basis points for the month. Up now for the year, 2.59%, which is great. And by the way, people often, I think, talk down trend following CTA performance, but in the B-Top 50 in the last 5 years, it's up 4 of those 5 years, including this year, it would be up 5 of the last 6 years. And the only down year was in 2023, where it lost 1.85%. That's not too shabby, frankly. Anyways, SocGen CTA index up 1.19% for the month and down only 35 basis points for the year. SocGen Trend Index up 1.77% for the month and now positive territory, up 0.86% for the year. The only real laggard I find, which is surprising to me, is the short-term traders index, down 53 basis points, down 4.8% on a volatility adjusted basis. That's a high number, actually. And given it's a year where we've had these short-term corrections based on statements and trade policy and all of that, you would kind of logically think, well, that must be great for short term because they can react to it. But that's not been the case.
I would agree, because it's interesting is that we would have expected short term to do better this year as well. And we've seen similar results. I think it just has to do the amount of sort of the frequency, right? So there's been a lot of like big event risk and a lot of moving around earlier this year that was difficult for short term. Interestingly enough, it seems that having sort of ironically like just a very long-term view this year in some asset classes would have been very helpful. So for example, equities, if you had just kind of ignored the noise earlier this year, that would have been helpful. And you may have seen sort of a mismatch in frequency for them. So for example, they're kind of seeing a new trend that's moving, following new short-term opportunity. And then sort of you get a swap back that, is at the wrong frequency. And I think that's definitely been the case this year, as you've been sort of particularly the first part of the year. Right now, shorter term movements could also be a little challenging because we've had occasionally little pullbacks, but for a longer term trend following system, pretty normal. But you've seen pretty big moves in things like gold over a 2 or 3 day horizon. It's interesting. We'll have to kind of see. It was just definitely a different kind of year. So I guess short term wasn't the savior in that scenario.
Yeah, no, very true. Now, I must be out of my normal routine since I've had 2 weeks off from doing podcasts because I completely forgot to look at the traditional markets that I normally also quote. Although I can see on my screen here, the S&P 500 is up about almost 3% for the month and up 16.25% for the year. So anyways, there we are. Let's jump to a question which I normally put in here at this part of the section before we move on. It's from Justin, who lives in the US. He's asking about what's the importance in terms of performance metric. But when you replied back to me about it, you actually framed it quite nicely, because it's about not just evaluating performance metrics, but also kind of the confidence and how robust it is. And I think what Justin was trying to look for is just, what are the key metrics that you would look for? Why those, maybe? And so I would love to hear your thoughts about that.
Well, this is a good question, because he was kind of asking about how do you determine the best metrics to determine which is the best trading strategy. And I think for me, always the most important thing to think about is sort of out of sample performance. And especially when you think about academic research, that's, kind of very important, in the sense that, you might have selected a set of parameters and a configuration that works very well in your back test, but it's really sort of the robustness of those parameter choices that matter to me the most, in the sense that, if you choose these 5 parameters, if you permute them at all, how robust are those performance statistics relative to those selection choices are probably my number one criteria. And the reason for this is it's so easy to overfit the past and to find a strategy that worked like in history. But what's hard is we live in forward in life. And so for me, it's about looking at sort of stability across your selection criteria. And then, of course, we always look at many of the more classic approaches. You want to look at downside capture, upside capture. You want to look at, Sharpe ratios. You want to look at many different things, but you don't want those things to be very susceptible to some of the decisions you made. And I think that's, for me, the most important thing about what we do, is combining methods that are sort of robust to the selection choices. That's how I start.
Let me ask you just a few follow-up questions, and we'll move on to the other topics. I think there's a school of thought whereby parameters are changed very rarely. Let's put it that way. There are another school of thought where they change dynamically over time. And there is one school of thought that uses more recent data. There's another school of thought that uses the most data you can get to select. There's one school of thought that may have different parameters per market or sector. And there's another school of thought saying, well, no, you should trade the same parameters on all markets. Where do you sit in that?
This is a really good philosophical question. And I actually think that you should do a little bit of most of those things. And so let me explain. So, if you look at a classic trend system like a moving average crossover system, that is somewhat unbiased in the sense that, once you pick your time horizons and how you estimate it, you kind of have a predictable response to market moves. Now, is this particular approach going to work the best all the time? Not necessarily. For example, one asset class may move quicker or slower or be more nonlinear. So my general view is that you can use more advanced techniques to try and shift how you adjust those parameters over time, things like machine learning, other methods, which can sort of cater to some degree and add some value over a more classic approach. Now, the problem is, and you kind of highlighted it, the past is not always the same as, the past and what's happening now. Things can shift. And I mean, this is something we've been talking a lot about as well, this idea that, in a world where bonds or the Fed's, has many dissents and all these things going on, maybe that bonds don't behave exactly the same. And that's where that school of thought comes in that says like, well, we should look at recent events. And so I think there's a grain of truth in all of those methods, but you probably don't want to stick to just one, because philosophically you're kind of, banking too much on one particular view of the world. So I think the best approach is really to kind of combine different methods with different assumptions and sort of aggregate those over time. And that should be the most diversified in terms of school of thought. And I think that's how I think about it.
I think that makes perfect sense. It kind of ties into something that I thought was very interesting that Alan and Yoav spoke about last week, and that is this idea, based on this paper that's a few years old, but I'd not come across it before, of market elasticity, and depending on their general reaction pattern. I mean, some markets react more quickly than other markets. Perhaps that is something to take into account when creating parameters, but of course you don't want to over optimize at the same time and make it too complicated. But anyways, if people haven't listened to that episode, I would definitely recommend to go back and listen to that, as well as actually the one with Nick and Moritz about the whole QIS space, which was very interesting, because that is one thing I would love, and I think they touched on it, and that is, why don't Nick and his friends report their performance anywhere? Why is it completely opaque to the world how these strategies are because they are so big in size? I mean, they're bigger probably than the official CTA AUM. So why would that not be a good idea to have some regulation or whatever it is to say, well, if you're running these strategies, whether you're a CTA or whether you sit inside an investment bank, that needs to be disclosed. Let's talk about some of the things that we had planned. Trends so far this year. Talk to me a little bit about that. The styles, the chunky ETF flow, slow moving replicators, and all of that good stuff that you know much more about than I do.
Well, it's interesting because I think, what we've seen in a pure trend space is Q1 and Q2 were very challenging. Q3 and Q4 have been much better. So, to me, it feels almost philosophically like, we had a huge shock to the markets around Liberation Day. And at that point, there was a lot of uncertainty in terms of price discovery and movements in markets that were, very, at sometimes erratic and headlines driven. So in that sense, you didn't really have, we had a big shock in terms of everything is changing. But if you think about it from a fundamental macro perspective, the world hadn't changed yet. So the market was really trying to assess that. And as we've started to see things calm down, of course, macro change is occurring, and you're starting to see sort of more consistent price trends in the market as some of that headline risk has toned down. Another thing which was very interesting to me that I'm looking at right now is if you look at sort of the typical sort of what, there are multiple names for this. So I remember early in my career, we called it coordinated market sell-offs. Then, a few years ago, a colleague of mine and I wrote this paper on turbulence metrics. So like turbulent days, so like high magnitude surprise days. Where you sort of have a huge move in terms of how CTAs react. And if you look at those, we showed that those are very negative for CTAs, and they usually the day after or the next day, they tend to like recover from these type of shocks. What was interesting with Liberation Day is that for the first time in history, within the time series I've looked at for turbulence metrics or magnitude surprise, Liberation Day was actually 3 days in a row.
Wow.
So that has never happened in the data that I have examined, looking at, lots of years of data. There's a lot of these events, right? There's SVB, there's Black Friday, there's, Brexit, other things. But, a 3 day in a row magnitude surprise, and then the market was flat, and then it went up. So I don't know what you would call that, like a deep U or something. I don't know, because it's definitely not a V. If you think about that from the perspective of a trend following system, we often, are able to sort of waver through a 1 day shock, right? A 1 day shock relative to all the data that we're investigating has sort of shock impact, but not maybe sort of massive impact. A 3 day consistent move is pretty large, right? And so as a trend follower, it's really the question of balancing between the strength of the trend and sort of the volatility as well. So if you have that type of move, it's not in the back test, right? There's nothing like this that's happened before. And so I think it's very tricky to imagine replicating that again, right? So like 3 days of negative shock, complete. Even COVID was nothing like this, right? Because you'd have a shock up, and then you have a shock back, and then, something a little bit more on those lines. This was much more of a U. And so I think that was interesting to me because it represents, it tells me how big of a shock this was to the markets compared to some of the ones that we've experienced in the past. And I think the market definitely was very challenging for trend strategies that are trying to measure the direction of the trend using data in that environment.
So I have a question. I have to, sorry to interrupt you here, but otherwise I'll forget. Now that the data is in the backtest, okay, I don't know if you've looked at that, but if you then ran a backtest today versus a backtest prior to Liberation Day, how would the parameters, I don't think the models would change, but how do you think the parameters would be different, or would they even be different? Because it's still only 3 days out of maybe a backtest running 15 years. So kind of, you just have to live with it, or,
I don't think that, you don't want to, you don't change based on, recent events and things like this, but it does, it does like sort of get you to start questioning like what these magnitude surprises mean.
Right.
And sort of, and it also begs the question of like examining how you measure your volatility and how it reacts to a much more sustained shock. And also sort of how signals react to sustained shock is definitely something I'm thinking about. Obviously, it's very hard to do those analyses because there's no statistical significance. They're one-off events, but it is something to note that this was a very unique price trajectory trend movement that we haven't seen in the data for CTAs. Doesn't mean it's going to happen again per se, but it does, get you to do some thought about volatility estimation, signals, and how they adjust to that type of movement.
I completely agree with that, actually. And also speaking to our researchers, I think they learned something during that period. So I would agree with that. What changes that may or may not be done is different question, but to say that they learned something, I think is completely fair. And more importantly, as you say, actually you should think about things when this happens, because it had not really happened before. So definitely. Actually, a colleague of mine, Mike, sent to me yesterday an article from CityWire. It was an article about AQR specifically, and it talked about how they had kind of coped quite well this year, but thanks to doing things a little bit differently, which we already touched upon, namely not just using price data for their trend models. Now, when we had AQR on the podcast a couple of years ago, Alan and I, they already did this economic trend for 50% of their, for one specific program. So if people want to listen to a little bit more detail about what they do, that might be an episode that they can find in the Top Traders Unplugged series on the website. But I thought it was very interesting. And of course, now that we've come out of a period of time with no economic data, we'll see how that actually worked out. But anyways, did you have a chance to just sort of skim through the article? And what are your thoughts about this kind of, I guess we could call it either alternative data trend following or diversifying trend following, or a bit of both?
I mean, I think it's very interesting. I mean, they highlight how they use single lane equities, and then they use 50% economic trend, 50% price trend. And generally, economic trend, or macro even as well, has done pretty well this year. And what that makes a lot of sense to me, because if you look at what's gone on, I explained there was a lot of headline risk that was causing a lot of chaos in price movements. Whereas if you step back and perhaps followed the fundamentals and looked at sort of what the overall themes of the economy were, you might have sifted through some of that noise. So that to me is very intuitive that worked well. I think one of the things I'm still sort of navigating myself, because I'm also very interested in economic trend, is it's a little bit more of an art to understand exactly what you're using. So it's more pretty much macro with a different name, right? And then what we need to do next is sort of distill what type of macro strategies actually connect to trend and how much trend capture they really have. Because I think the challenge for any investor is going to be, if they're looking to capture trend or the features of trend, no doubt there are scenarios where macroeconomic indicators or data can predate or can give an indication of a future trend. But there's also, the other direction where they actually predict a trend that doesn't actually occur. And so I'd say it's interesting, and it's something I'm actually thinking about. I'm hoping write a little bit about it at some point. But the concept of, trend capture, how much do economic trend models capture of price trends? And how do they complement, and what part of that trend capture is connected with sort of, price trends themselves? And I think, if you look at macro, and we have a paper coming that we've been working on macro trading, it has a very high correlation with trend following, at least a lot of macro managers. And this is, a question of what part of the trend are they part of? Because the truth is, we're all trying to capture global trends across asset classes, and there are different methods to get in and out and or participate in those trends. And I think for me, economic trend is one way. The challenge, of course, is the art of how you implement it and what data you use. But there's definitely some connections between economic trend and price trend.
Couple of thoughts. I'd love to hear your thinking on this. So when I read the article, and I don't remember sort of word by word, but one of the ways that they were writing it, and I don't know if this was the journalist or whether this was something that came from AQR, but it was this thing of, they were trying to diversify kind of the responsiveness, meaning that the data has, investors have different time lag in terms of how they respond. That's how trends form. And by using economic data, they were trying to maybe capture some things that had not played out in the price data yet, for example. Okay, so this concept is kind of interesting to me, because one of the things, at least in my career, that we've kind of tried to stay away from, and that we say about trend following, is that we don't try to predict.
Mm-hmm.
And one thing that we also have to acknowledge, which is some people would say it's a weakness, is we cannot anticipate either, because we need the data and we need some time to adjust. So in a sense, when I hear this, it feels a little bit predictive. It feels a little bit, maybe this is a way to get the anticipation into your trend model. Now, love to hear your thoughts about that. But what it also reminds me is an interview I did very early on in my podcasting career, quote unquote, with a systematic global macro manager out of Sweden, IPM.
Mm-hmm.
They had fantastic track record for many years, and they kind of raised all the assets in the space, and there was not much left for the rest of us until it stopped working.
Mm-hmm.
And they didn't blow up, but they didn't make money, and they were in a drawdown when they decided to close the business. So, and maybe that's just how it works, that you like the trend, you have your periods where it works, you have your periods where it doesn't work, and maybe that's why it's a good idea to combine. I don't know. But all I'm just saying is that sometimes when I read these things, and I'm not suggesting that AQR is doing the same as IPM is doing or whatever, nothing like that. I'm just saying that I think all approaches will have their time in the sunshine and their time when things don't work so well. But right now, it's more about the time in the sunshine when I read about these things, because recent performance has been certainly helped, as they say in the article, by this. So that's kind of my two cents.
And it's interesting you bring this up, because I do think one of the challenges with trend following is, and I was just doing a presentation this week on Crisis Alpha that, it was an academic presentation, but I was looking at one of the old graphs that I love to plot, where you look at how does the SG trend perform in different quintiles, like the worst quintile and the best. And, over the history, it's that the worst case scenario, that convexity, that, those opportunities that occur in a time of stressful market environments, which do provide a lot of complementary benefits of trend following. And that's exactly the idea that, in times of stress, oftentimes the fundamentals become irrelevant, right? And so it's really about the world changing and prices are changing. And so trend is really very good in that type of environment if it's sustained. We're actually this year not in that environment. You already mentioned it yourself. The S&P 500 is up 16%. And, macro data and information has suggested generally positive themes. And if you followed that information, you ignored some of the price noise around the headline risk. And, it was a good strategy. So I say that each of these strategies and approaches have their days of sunshine and days of rain. And I think, I do agree that, depending on the investor, combining them can make sense if depends on their mandate, right? If we have certain clients that their main mandate is risk mitigation and they like trend because they know when it's really bad, it tends to do very well. And they also understand that in a year when their S&P is up 16, it might do okay or not, and that's kind of a question of construction and investor preferences to me. So I think all these strategies are viable in different ways and different times.
Okay, we will end up on a positive note, but before we get to that, you wrote a few comments to me about, and I don't know if you feel we've already discussed it. Yeah, maybe we did the 3 days in a row topic about the Liberation Day. So let's move on to the next topic, which I thought was very interesting. Something that I don't even know where I got the link to the article. It was an article or blog post from Capgemini, and it was titled "The Rise of Alternative Investments" by Jia Jan, I think it was, and it talks about how alternative investments are really reshaping the wealth management industry. And one of the, and I'd love to hear your more detailed thoughts about this, but one of the headlines or sub-headlines in the article was something like how some of these consultants or financial firms were essentially thinking of alternatives becoming the core, not the alternative in a portfolio. And that this could lead to a rise, according to them, from the current $4 trillion or so invested, all the way to about $12 trillion by 2034, which is not that far away. And then other groups were estimating alternatives would hit 30 trillion globally by 2030. I think that was Everest Group that had that prediction. So, I mean, these are not small changes. I mean, these are like complete game changers if this is true, or even comes close to being true. It also talks about how institutions and different types of investors have really approached alternative differently. Some people, a 3% allocation is enough. But once you move into the kind of high net worth individual space, and private investors, 20-25% seem to have been much more the norm. Family offices, actually some of the ones that use alternatives the most, 30-50% allocation has been mentioned. And the one thing that actually I thought about, and this is something I've been thinking about for like the last 20 years, and this is this thing about fiduciary responsibility. Because I thought as a fiduciary, your job was to pick the best investments for your portfolio. And this is not necessarily a block for managed futures or trend following. It could be other strategies. But it's very hard to objectively argue that it doesn't add value to a portfolio. I mean, there's never been a white paper written to suggest the opposite. So I've always kind of thought, how do the fiduciaries get away with having no allocation to trend or 1% allocation to trend? Maybe this is also part of the change. I would love to hear your thoughts about this, and also whether you already see signs of this in your conversations, in your kind of the construction of the types of investors you see the flows coming from. Would love to hear that.
I mean, I think the most interesting thing about this particular paper is not just like the flows to alternatives, but it does focus a lot on private wealth. And I think of that as sort of, if you look at the way, especially when I speak with my friends in Europe, like the way that sort of investment management is bifurcated in the United States between institutional investing and sort of private wealth and, retail investing, there has been a lot of limitations and barriers to sort of accessing very fragmented pools of capital. And I think what's happening, I think there's a market opportunity because, stocks and bonds, for example, with bonds being a little more challenging, has made, larger investment firms have to ask questions like, can we just make it there with just stocks and bonds? We need to think about this more, and we need to think about what these institutions are doing differently from us and how we can sort of import some of that wisdom. And I think the interesting part, I mean, that's just exciting with AI and all these other things that can solve can aggregate information more quickly for us. Sort of the development of model portfolios and solutions and more access points. And this paper actually argued a little bit about that as well. This idea of, access to these things changing. Access is a function of both new products and new legislation. For example, the ETF market is a good example of that. But it is sort of a slow evolution that seems to be speeding up after people, have perhaps been a little bit concerned about the 60-40, right? So I think for me, it just shows that there's a wide range of investors out there that are limited in their diversification compared to an institution. And I think that, by aggregating these approaches, that you can actually have access to a wider range of investment options. And even the article mentioned some of the larger banks and investment firms kind of examining alternatives access for their clients and the private wealth. And so I think it's a wave that's coming that is going to continue. And so I agree with the article. I think it's going to be interesting to see how that develops. And sort of, I think accessing these networks and working with them is going to be important. I think you and I have many times you've asked me questions about sort of like knowing your client, right? So that's going to be, I bring that up because that's important to you, Niels, and you and I talk about that a lot, especially when we talk about ETFs and other things. So I think that there's going to be a lot of education necessary. There's going to be a lot of people that need to sort of understand, and obviously larger investment firms are going to have to spend resources to cover, manage, and sort of understand alternatives. We have been, for a long time in the alternatives completion space. So like building portfolios of alternatives together. And I think that's something that we strongly believe. And I believe I've talked about this many times with you, is like, interestingly enough, it's like having some trend following or managed futures of any type actually gets you farther than you would think, just because it's one of the few things that's actually different if you just own stocks and bonds.
Yeah. I had completely forgotten about that little pet peeve of mine where if you just get all the flow through an ETF, you don't know who the underlying client is, and how important it is, in my opinion, to know your clients, especially in the year like this year where I think people got nervous after Q2, where people didn't really feel that comfortable in the trend space. But if you know your clients and you can actually reach out and talk to them, you can avoid a lot of unnecessary hardship on their side by them making allocation decisions at the wrong time. So thanks for reminding me about that. Now, let's, as we always do, let's look at it from a purely selfish perspective. If this is true, how do we as an industry, do you think, how should we position ourselves, or what should we do different to try and capture some of this? And I know full well that this will be captured, I'm sure, both through managers like ourselves, but also through replicators, for sure. Uh, and obviously, one doesn't mean that you shouldn't have the other, and vice versa. But what else can we do to be part of this potential, tidal wave of assets that could flow into alternative investments? Because alternative investments, I think, also includes private equity and private credit. And to me, that's not really that alternative, right? That's really just the same thing in a different, clothing. But the true alternatives, like what we do, well, how do we take advantage of this opportunity?
Well, I think it's important. I mean, they talked about access points. So, I mean, clearly, creating products in different wrappers like ETFs is one way you can sort of be active in these spaces, but also sort of maintaining relationships with key stakeholders in these spaces. For example, model portfolio researchers. So those are the people, that's your client in some sense. And sort of getting to understand the private wealth network and sort of how you can support that and help them make educated decisions about things like managed futures is sort of our next educational journey in this space. I know we've, clearly there's been a lot of focus on the institutions in the past. The new wave is really probably private wealth and also sort of aggregators that are thinking about model portfolios and model selection and manager selection.
Good stuff. All right. Final topic, which is not really a topic, but I'm always curious about, I know you mentioned you're thinking about, or you already have started writing about, so trend and global macro. What else kind of interests you? Because I know you're someone who not only produces a lot of papers during the year, but you cover a lot of different topics within our industry. What else after a year like this year that has been so, I wouldn't say different because every year is different, but so wide-ranging in terms of the challenges and the tailwind we've had? What else inspires you at the moment?
So I have two papers that I'm almost done with. One's on macro and trend, and another one is on utilizing managed futures in target retirement portfolios.
Tell me about that. That's
This
not
is,
something I've
again, something very, I mean, it
thought
goes to
about.
the same discussion of like new avenues
Okay.
for managed futures. We're interested in this topic because if you think about target retirement, it's really a long-term investment problem, but the objective is a little different than a pension fund. The objective is to improve some of the worst case scenarios for retirees, right? So what we do is we model sort of cash flows for a typical target retirement with, and it's not done yet, but I'll definitely send it to you when I'm done. But the idea is that
Sure.
managed futures can improve some of the the worst case scenarios or some of the sort of bottom 5% where sort of you have poor market timing in terms of when you allocate or when you withdraw. And I think that's very interesting because they have a different objective in target retirement than you might have sort of best risk-adjusted return for a portfolio. More to come eventually. It's not ready yet.
Yes. Okay.
Yeah.
I don't want to take all your thunder, but I will ask you just one follow-up question. So, because again, target retirement plans are probably more common in the US than they are in Europe. You would think that as we get older and nearer our retirement age, that our portfolio construction should look different. I think, well, if people have listened to the podcast since it began, they're like 14 years older than when they, started, or whatever, how many years we've been going on about this. So they're getting closer to retirement. So how should they, as you get older, how should you think differently about your portfolio? And also, without again taking all the thunder away, how should you think differently about, or how will that impact how you should think about trend following? just broadly?
Well, I mean, I don't think we answered that huge philosophical question exactly, but what, the allocation that you have, and that's why our conversations about the total portfolio and this conversation about adding alternatives, those choices matter. Obviously, when you're thinking about retirement, those may be time varying as well. I think what we are trying to understand is, sort of, we all understand that trend following, especially with equities, has a naturally, more diversified approach, and it has lower maximum drawdowns on average. And so if you're thinking about, the average of the population, that matters. But, if you're actually thinking about individuals, each individual has their own sample path. And depending on when they're getting close to retirement, they want to sort of minimize those drawdowns so that they have enough time to recover. So I think it's an interesting question. And for me, that's a hard question. I mean, we try to look at that a little bit because the value of managed futures is that it can help reduce maximum drawdowns for a equity-focused portfolio, and that can help over a longer term avoiding some of the worst case scenarios, especially if you think about, you accidentally decided to retire in, 2008, for example, when the market's down 60%, that individual is actually adversely affected more than, say, the person that retired and decided to adjust their allocation, for example, in 2007. So I think that's a good question. I don't have the whole answer for you yet, but it's something we can talk about
Well, the
another
paper
time.
isn't done yet, so I'm expecting all the answers in the paper when we get the chance to talk about it, of course, Katy. This was wonderful, as always, very wide-ranging and super educational. So really appreciate your time and your efforts in preparing for this. It's not always easy to come up with new ways of talking about the same thing each week. So I always appreciate the help I get from you and all the other co-hosts in that. Speaking of new angles, next week I have Rob Carver coming back on the show, and you said something interesting about Rob just before I pressed record. Tell me more.
Oh, Rob has a really fun post on volatility forecasting and if it helps. So I would love for him to talk through that next week. So ask him about it.
So we're putting down the challenge, and I'm sure he would want to bring it up anyways. He and others obviously like to do that, which is perfect. So anyways, if you have questions for Rob, info@toptradersunplugged.com is the email to do that. If you want a copy of the paper that we did at Dawn regarding where we combine where we compare all the alternative investment strategies, including trend, and see how they perform, as Katy said, during crisis periods and why they might be a true alternative. If you sign up to the weekly newsletter that I do, you can do that on toptradersunplugged.com/TTU-news or however you pronounce that. Then from time to time, I will promote that little paper, and you can see for yourself what these things do. And finally, very importantly, if you want to show your love for Katy and all the work she does, and not just here, but everywhere she shows up to educate people about trend following, then head over to your favorite podcast platform and leave a rating and review, because there is a lot of work that goes into preparing these conversations. So it's nice to see some positive feedback on that. Anyways, from Katy and me, thanks ever so much for listening. We look forward to being back with you next week. Until next week, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.